A handful of American tech giants are now driving growth in the markets. And is there an alternative? We're going to look at another perspective on investing, and we have invited an American advocate of value investing. She is the founder of Summit Street Capital Management, where she's also the Chief Investment Officer. Please give a very warm welcome to Jennifer Wallace.
Hello. It is a true pleasure to be here today, even though it's frigid. I thought what I'd do is take a more practical approach rather than an academic approach, share just a bit of an overview of our firm, how we think about investing, and then talk about a couple of ideas that are investments in the fund today that will bring our process to life a little bit. We'll leave some time for Q&A. So my partner and I launched Summit Street 17 years ago. We manage assets in a commingled fund and in SMAs. We're deep value, long biased, and at times we hold significant amounts of cash. Let's see here. Does this work? Are we moving this? Okay, I'll let them do that. We hold significant amounts of cash. Oh, that's okay, thank you. Great. We're focused on US public equities of generally global businesses. And at the end of the day, our objective is to compound our partners' capital safely. So how do we do that? We do that by buying common stocks of what we perceive to be uncommonly good companies when we can find them at bargain prices. So at Summit Street, what we stand for is value at reasonable to high quality. And investing, in my mind, boils down to two essential questions. How good is something, and how much do I have to pay to get a piece of it? And in our experience, successful investing really happens at an effective trade-off between quality and value. We're looking basically for major price dislocations. No stock ever gets cheap enough for us to be interested without a significant problem, real or perceived. And so because of this, we avoid leverage. We avoid leverage in the fund and at the portfolio company level. The companies we invest in generally have low to no debt because the situations that attract us occur when that company, its industry, or the economy broadly is facing a headwind or uncertainty. And in those situations, the strength of a company's balance sheet, we sort of call it the runway for recovery. Its ability to invest incremental capital at high rates of return help us to separate truly sort of attractive investments from companies that look cheap on a multiple basis, but maybe they deserve to be cheap. So this element of balance sheet strength, I think, is a very important and often underappreciated aspect of quality in a portfolio. Obviously, we're looking for management teams that are sort of aligned with shareholders. They demonstrated that they're good allocators of capital. And that's important because if the balance sheet is really strong and there's excess cash, we're counting that as ours. So we need to be sure that the management team is actually going to use the capital well. So at Summit Street, what we combine is a very strict discipline regarding value and quality with a relatively unconstrained mandate around industries and cap sizes. We're benchmark agnostic, and our portfolio is fairly concentrated, 25 to 30 stocks most of the time. And there are whole areas of the market that we do not invest in, including most traditional financials, utilities, and REITs. Why is that? The leveraged business model, effectively, of these companies just don't allow them to meet our quality requirements. So we take this very fundamental approach based on primary sources of information, and we're thinking about risk. Back to this question of compounding capital safely. Risk, in our view, is the chance of permanent capital loss. Risk is not volatility in our mind. Volatility is what we try to use both on the upside and the downside as opportunity, buying and selling, perhaps. So this is a long-term chart of Summit Street's performance. The returns have been good, particularly when you consider that they've been earned without the additional risk of leverage and the fact that we hold upwards of 30% cash. We've averaged about 10% cash over the last 3 years. And what I think is particularly interesting is that the stocks we own are typically twice the quality of the broader index as measured by ROE, and yet significantly less expensive. The caveat I would offer is that at times our performance is poor on a relative basis. Our investment strategy tends to do okay when markets are broadly rising, but we create most of our value when major inefficiencies get corrected on a stock-by-stock basis. So what does that mean? It means we have to have great clients. We have to have clients that can tolerate this when the markets are rising indiscriminately, a little bit like now, because they can then benefit from our disciplined approach, like in a 2022, when the market was down a lot and we were essentially flat down a little. So it's that long-term value approach that a client can benefit from if they can tolerate periodic underperformance. But ultimately, in my mind, what matters in investing is sort of what do you pay for a stock when you buy it? What do you get for it when you sell it? And what do you collect along the way while you own it? Everything else is essentially noise and just sort of, movement of pricing in the market. And at the end of the day, investing is probabilistic. In my experience, the key to achieving good results is to invest when there is a lot of bad news or uncertainty priced in and when expectations are low. So obviously the goal is a high hit rate and a positive skew, which we have been able to achieve. And the truth of the matter is that high quality value equities have a long track record of outperformance. Clearly, we've seen years, practically a decade, where value has, as a strategy, underperformed. So what's the world look like today? Obviously, the pandemic and the subsequent response and recovery have created a fair amount of volatility. Over the short term, no stock is immune from a decline, including ours. However, I firmly believe that an unlevered portfolio of unlevered cash-generating businesses is anti-fragile, and it therefore is protected on a fundamental level. So in our experience, strong companies are able to take advantage of volatility and economic disruptions. They are able to invest through downturns, ultimately take share from weaker competitors. And when a business that generates excess cash goes unappreciated by the market and becomes available at a bargain price, we kind of think of that as a financial inevitability. Because over the long term, stock prices reflect the economic value that the company creates. That said, rather than looking for these major price dislocations and financial inevitabilities, most market participants and pundits appear more interested in talking about political uncertainty, geopolitical tensions, the daily moves of the Mag 7, or the latest Fed minutes. And driven by capital flows into passive investing, few people, and fewer each day it seems, are focused on the risks embedded in this very narrow and very expensive index to which a lot of capital is flowing. Obviously, we know, and Siri mentioned, the 3 largest companies in the S&P today comprise 21% of the index, and they're valued at an average of 44 times earnings. So trillions of dollars are basically flowing into indices dominated by these expensive stocks without regard at all to individual company fundamentals. So in the fullness of time, I expect that this fascination with momentum and cheap beta will end up being a bit of an expensive mistake, but time will tell, right? It manifested itself in 2022 when, if you looked at the equal weighted index versus the market cap, the equal weighted outperformed by probably 14%. That has reversed in 23 and 24, with the equal weight up about half of what the market cap weighted indices have returned. And in my view, this is really just ongoing momentum that becomes a bit self-reinforcing, and this sort of AI frenzy, which we can talk more about. I think the biggest issue is that it creates some asset level risk for the market as a whole, but it also creates pretty attractive investment opportunities. Individual stocks may go improperly valued as fewer and fewer people are doing the analysis, right? Markets in some way are becoming less efficient because less capital is deployed against fundamental analysis and investing as more capital gets deployed into indexes. So in 21, I would say the spread between low multiple smaller companies and high multiple mega cap companies was as wide as it had been at any time, except at the height of the dot-com bubble in 1999. It's come down from its peak. You could say the market has broadened a bit, but the gap is still very wide by any historical measure. So because of this divergence, even in the context of a generally expensive market, we're finding underfollowed, misunderstood companies. Often they are outside of the indexation vortex that we believe present very compelling opportunities. So our portfolio today is priced at just under 10 times cash flow. We have our stocks have an unlevered ROE of about 30%, so they're high quality and they're cheap. And they demonstrate not only high returns on capital and carrying a low debt burden, but they often have net cash, some degree of franchise value or a moat, and the most important thing is that they trade at low multiples of the cash we expect them to earn over time. So our requirement for a strong balance sheet, our focus on cash flow, has led us to holdings that are often quite different from other value managers. What I thought I would do is talk briefly about a couple of those holdings to bring our process to life, because I think it can get theoretical if you don't take it down to a stock level. One company I'll talk about is a biotech company that we've owned for quite some time. Biotech typically isn't a word you hear next to value, and so I would say it's sort of a non-traditional value investment. And the other is a developer and licensor of intellectual property. So as I mentioned, nothing gets cheap enough for us to be interested without a fair amount of uncertainty or bad news. During the last few years, there has been no shortage of uncertainty in healthcare, and that has been reflected in the prices of the stocks. Healthcare has underperformed the broad market since 2016, and as of the end of 24, it was the second worst performing sector, trading now at a 26% discount to the market. I don't believe that all is lost in the world of healthcare, and we have an investment that we think is mispriced, was mispriced when we bought it and continues to be, due to a combination of, I guess I would call it false pattern recognition and general industry disfavor. It's done well, and we believe it continues to offer a very attractive value today. This is a company that has an outstanding record of value creation. It's grown revenue and core franchise at about 11% a year for over a decade. It earns returns on equity north of 15%, operating margins of 40%. It's invested $4 billion in R&D over the last half a decade. And they recently completed a $1 billion stock buyback that reduced shares outstanding by 7%. So in our view, a company with those financial characteristics should trade at a premium. But in May of 2019, when we first, well, it was the second time we bought the stock, but when we bought the stock this go around, it was trading at just 6 times earnings net of cash and 1.8 times book. The stock has essentially quadrupled and remains a genuine bargain today. The company is called United Therapeutics. It might strike you as an oxymoron. It's a profitable biotech. Less than 20% of all biotech companies ever turn a profit. So it's in rare air. It's a pure play on an orphan drug. And in mid-2019, this company had an equity market cap of under $4 billion US and was changing hands at under $90 a share, down almost 50% from its mid-17 high. We thought the decline then was unwarranted, represented an excellent long-term opportunity, and even with the uncertainty around healthcare, by our analysis, this was a company trading with more than a 100% margin of safety. The company has continued to compound in value. Today, it has a market cap of $17 billion, a share price of $360, and it's probably worth almost $500. So unlike price gouging, generic, Me Too kind of drug companies out there I would put in the villain category, United Therapeutics is sort of a healthcare hero. They have leading drugs to treat a progressive, deadly disease, and they are investing in R&D to improve treatment options and hopefully to find a cure. So in 85, let me just sort of give the highlights. 85% of the revenues of this company come from a molecule called treprostinil to treat pulmonary arterial hypertension, which is, as I said, degenerative, deadly disease. It affects 45,000 people in the US. It causes high blood pressure in the blood vessels of the lungs. It leads to breathlessness, fatigue, and eventually heart failure. The only cure is a lung transplant, and today there is a dire shortage of organs available for transplantation. If you are diagnosed with PAH, your life expectancy is 5 to 10 years if you have access to treatment, and 3 to 4 without. Nonetheless, so it sort of sounds like this is a company in a sweet spot where if you want to live, you have to get treatment, and they're doing sort of God's work with treating this disease that is so dire. But the company faces challenges. The patent for a drug that was 30% of their revenues expired in 2018. As we know, patent expiries are usually existential for drug companies. The average drug loses 80% of its revenue upon the launch of a generic competitor. And based on this, in 2019, analysts were incredibly pessimistic about UT. This is where we get into the question of pattern recognition, a little bit about behavioral psychology. I've seen this movie before. I know what's going to happen. UT is going to fall off a cliff. But we thought that was false. And it turned out that the franchises of the United Therapeutics drugs are significantly more durable than the market appreciated in 2019. And I would argue that the market even appreciates today. So notwithstanding patent expiry, Remodulin, the drug that we're talking about, retained an 80% share of the market. And rather than a patent cliff, the revenues of Remodulin increased 25% quarter over quarter when the generic was launched. So I would argue this is good evidence of the durability of the franchise, and UT continues to innovate in ways that allow it both to protect its franchise and to improve patient outcomes. Secondly, there's another drug based off of treprostinil called Tyvaso. It's an inhaled drug, makes up today about half of the company's revenue. And what was totally unappreciated by the market was that there was the opportunity to double the addressable market for Tyvaso by also treating pulmonary hypertension associated with interstitial lung disease. And so instead of 45,000 patients, there's now an addressable market of around 90. And there's a study underway today to treat patients with COPD to double again the market, addressable market. So this is a company that has now 12,000 patients that they are currently treating, and the target is to reach 25,000 next year. The company's run by this shareholder-friendly, forward-looking management team that's managed capital allocation between investing in R&D, which they expense. I think that's important, and buying back stocks. There's about a quarter of the stock price is held by the company in cash, and they continue to invest in what I would call free calls, longer-term optionality for upside that we don't give any value to at all, but could be worth quite a lot, developing ways to answer the question of how do we get more organs available for transplantation. They are building basically condos for pigs, and they're raising genetically modified pigs for xenotransplantation. They are decellularizing pig organs and then recellularizing them with your own DNA so that your body won't reject their, I mean, if you think about it, you get an organ transplant, you live, but you're trading one disease for another, right? You're trading the disease that would have killed you with a disease that you can treat, but it's the rejection risk. So in addition to getting more organs for transplantation, UT is looking to cure the risk of rejection. So since 2019, the stock is up over 300%. But what's also interesting is since 2019, the company has earned in free cash flow the same as its market cap was in 2019. So it was under $4 billion in 2019. And since then, the company has earned $4 billion in free cash flow. To me, that's a financial inevitability. We've already now been paid back effectively for what we spent on that company. I think it's conservatively not giving any credit to these free calls. It's probably worth just under 500 if they reach their goals, which they've, $4 billion revenue by the middle of the decade. So I think it offers it's an interesting company. It's off of most people's radar. I never hear anybody talk about United Therapeutics. It offers an attractive opportunity in an unloved sector, biotech and pharma. It's a hero, healthcare hero, treating people who face a terrible diagnosis. And we think it offers a large margin of safety with pretty conservative assumptions and some significant upside. So United Therapeutics is the kind of company we like. It's got these characteristics of being financially inevitable, even if nobody's talking about it and capital flows seem to be going the other way. The second company I thought I'd touch on briefly is InterDigital. Again, an underfollowed and misunderstood pioneer in digital technology. InterDigital, how many people use a cell phone today? Everybody, right? InterDigital is one of the most important companies to the way we live our daily lives that most people have basically never heard of. It develops the technology by which all wireless communication is possible. It's a small company. It only has 450 employees and a $6 billion market cap. But it plays an indispensable role in the smartphone market, which is $500 billion market by most estimates. The other players in this space are names like Qualcomm, Ericsson, Nokia. They have market caps somewhere between 6 and 60 times that of InterDigital. So what do they actually do? InterDigital develops and then patents technologies that are embedded in the standards by which all wireless devices communicate. Think cell phone, connected TV, appliances, automobiles. Its patent portfolio is growing. They had less than 20,000 patents in 2017. They have more than 32,000 patents today. And it's increasingly diversified. So the business model is basically to secure a license with a device manufacturer who then pays InterDigital for the right to use the technology. So customers include Samsung, who's been a customer since 1995, Apple, Xiaomi, Lenovo, LG, Panasonic, Sony, Amazon, and other consumer electronic companies, and some of the auto companies like Toyota. About 90% of its licenses are priced on a fixed basis. So it doesn't really matter to InterDigital if smartphone purchases are going up or going down. And in fact, today, InterDigital's technology is in literally every smartphone that is sold and used. In 2023, there were over 1 billion smartphones sold. So this sounds kind of like an obvious stock. Who wouldn't want to be in a company that we can't live without now that we've become so addicted to our smartphones? But what makes InterDigital misunderstood and underfollowed is that it's small. When we started looking at it, it wasn't really in any of the big indices. And it's difficult to analyze because revenues are uncertain and the timing of license agreements is uncertain. So there's this notion of recurring revenue. I've got a license and you're paying me just like we've agreed. And then there are one-time payments. One-time payments are either our agreement has lapsed, but I've continued to use your technology. We sign a new agreement and I agree to pay you what I've been using and sort of owe you as a one-time catch-up. Or we're signing a new agreement for the first time, but I do admit that I have been using your technology without paying you, and so now I'm going to pay you that one-time catch-up. So these one-time catch-ups, which are essentially 100% profit to the bottom line, do make it, and the uncertainty around them, make it a little tough for someone to say, well, what's next year going to look like, or how am I going to analyze this from the outside? Additionally, there's really no other company that does just this. It's a unique business model. There's no direct comparable, which Wall Street hates. So even sophisticated people like the Wall Street analysts seem to have a hard time modeling this mix of recurring and one-time payments. But however you want to look at it, this is a capital light, sustainably high margin business trading at less than 20 times earnings, less than 13 times cash flow, and generates excess cash that the management team has kindly returned to shareholders. Since 2019, when we first bought it, and the stock was changing hands under $50, the company has earned its, again, entire market cap in cash flow and returned 100% of free cash flow to shareholders through dividends and buybacks. So, again, I would say it doesn't really matter where capital is flowing. It doesn't matter that the indices get all the attention. If you're buying a company that's generating excess cash and doing intelligent things or shareholder-friendly things with it, it's a financial inevitability, and we like that. So today, I think it's like $200 a share, that still got plenty of room to continue to grow revenues. It remains a compelling investment, probably worth $300 if they achieve their goal of $1 billion in recurring revenues. So these are just two examples. We have a portfolio of companies like that. Most are facing headwinds of some kind or another. They've got some reason that they're being ignored by the market more broadly. They've got a significant margin of safety and the potential for attractive upside. So at the risk of stating the obvious, to earn excellent investment returns, one must be able to buy low and sell high, right? But way easier said than done. It can be very difficult to do when the wave of sentiment is against you. And in our experience, you've got to look for unappreciated financial inevitabilities, ignore the noise, with the full understanding that from time to time there will be periods of relative underperformance. And while history tells us that mean reversion remains a powerful force in markets and that value outperforms growth over time and in higher rate environments, rather than merely wait for these forces to present, we are looking for companies whose cash generating potential is attractive enough that the company can become its own catalyst for value realization. So for those that can do this, those who have clients that allow them that time horizon, you can stand apart from the crowd, and I think that is your way, your hope, to achieve superior long-term returns. So a great quote from Ben Graham, did I have it here? No, I don't, is the intelligent investor is a realist who sells to optimists and buys from pessimists. And with that, do you want to turn it over to questions? Thank you. Thank you.
Many thanks, Jennifer. I'm going to bring in some questions from the audience now. If you do have questions for Jennifer Wallace, please send them in, and the chances you will be getting that question.
Okay.
Yeah. So I'd like to pick up on one straight away. There's a participant asking, when will you sell? Is it when you see that the, as he says, or she says, when the fundamentals tell you price is too high, or when do you sell?
That's a great question. And when we talk about the sort of confirmation bias, we talk about all of our own prejudices. We actually love the stocks in our portfolio. By our human nature is to love the stocks that have gone up and to hate the stocks that have gone down. I use actually some guardrails to help me avoid some of the natural human biases. If a stock goes down, we revisit our analysis and we will almost, not always, but almost always buy more. I believe in an equally balanced, by and large, portfolio. So that helps you buy when things are going down and to trim when things are going up, right? Because you don't want, nobody invests in Summit Street thinking they're going to get a two-name portfolio. You basically invest in Summit Street thinking you're getting 25 to 30 stocks that have a set of financial characteristics as I described. Selling is, for us, has been more of a trimming. Earlier in my career, value investing worked differently than it works today. Earlier in my career, you had companies that were trading at a low multiple, and eventually they would get through whatever troubles, and people would realize, and the multiple would go up, and you could sell. So essentially, you were taking the multiple change. If you were so fortunate as to have a company that was also under earning, and then they earned more, you could get the double bang. You get the earnings growth and the multiple growth, but you were selling a company based on its valuation. There is less capital, as I mentioned, thinking about stocks in that way. So it's no longer this multiple reversion game. You really must look for companies that can compound their own value. What that means is that we hold stocks longer, because if we're right about them compounding, they will grow and their value will grow as well. They become their own catalyst for value realization. We sell when we trim. We sell when a company, as I said, there is volatility. People do become enamored with things. And so if a valuation exceeds by, a margin of safety, we don't feel comfortable keeping our clients' capital at risk in those situations, and that's when we sell. But there's been this I would say over the last 17 years, we do hold stocks longer now because of the structural change in the market.
And what about that? If you find something that is really a bargain price and it is a quality company, but nobody else realizes, and the years go past, the value trap, how do you avoid that?
So coming out of the financial crisis, this is a topic that used to keep me awake at night, literally. And it is a reason why I believe many value investors have underperformed. My mentor and everybody in sort of like a generation ahead of us thought about price to book. Buy things that are cheap on a multiple basis, and you will get this multiple reversion. I have always believed in the cash flow, right? Book value, because of globalization and a whole bunch of other accounting changes, has become less stable as a measure of value. It used to be a very stable and meaningful measure of value. Earnings, we all know, can be manipulated, but cash goes to the bank. And it's interesting because we've had stocks. We had one stock where the cash wasn't showing up in the bank and the balance sheet wasn't looking like what we expected. And we sold the stock and we realized later that it was a Chinese company not really disclosing what the ownership was or where the cash flows were going. And so a value trap to me isn't a cheap stock. But if you buy a cheap stock, especially in today's market, it's like a tree that falls in the woods and nobody hears it. Did it make a sound? You found a cheap stock, but nobody cares. Are you ever going to make money? Maybe not, and especially given capital flows today. So value traps, in my mind, are investments that you're buying just on a multiple basis. But if you're buying stocks that are cash flow generative and you're right about your analysis, essentially what you're getting is the company is its own catalyst. It isn't waiting for the market to give it credit. It's giving you, and you know what happens is these companies either keep shrinking, you get a bigger share of the pie, they give cash back to you, which is wonderful that you can redeploy, they get acquired by a strategic or a financial buyer. It used to be more financial buyers. Now it's more strategic buyers, given interest rates. But you're putting yourself in the way of lots of good things that can happen, if that makes sense.
You mentioned the Mag 7, and they have been outperforming the others. They are driving growth in the markets. What do you think of the pricing today?
So there have been other times, Nifty 50, the tech bubble, even in late 21, there was this index called the Goldman Sachs Unprofitable Technology Index. And it was up, like crazy. Unlike those times when there were bubbles that then burst, today, if you look at the Mag 7, they are, by any definition, much better quality companies than in prior bubbles. Would I argue that we're in a bubble? I'm like a Cassandra. I've thought so for quite some time. Look, today, the top 10 stocks in the S&P, they returned 63% last year. They are currently trading at 41 times the next 12 months earning, 57 times trailing, and they make up 41% of the S&P. So I think you have to ask yourself, how am I going to make money on a fundamental basis if I'm buying a stock and paying today already a price that accounts for the next 41 years of earnings, not even accounting for any discounting? Maybe their earnings grow, but I don't think that's a great recipe for investing, and I think it does create asset level risk. The bigger risk, and the thing that worries me the most, is if you think about a lot of unsophisticated investors and a lot of retirees and a lot of 401ks, they own the S&P 500. And the S&P 500 now is basically anti-value. Index investing is anti-value because by definition, you are buying more of what has already gone up. You are not buying more of what is undervalued.
And I know you think we don't really see the risks of index, and you've written a paper about that. What should we be most concerned about when it comes to the index? Is it the lack of spread? Is it the concentration they actually have? Or what is the problem?
Well, I mean, if you think, I think today you look at retirees and they're in like 30% or 40% of their holdings are in 10 stocks that are not cheap. That's a risk to me. That's a risk to them. You know, indexation is a broader question, and there's been a lot of change in what the index actually is and how it measures. The S&P 500 used to be a index that was market cap weighted. Today, it's market cap free float weighted. Well, if you look at the historical returns of the S&P, it included companies that were founder-owned, the Walmarts, Microsofts of the world. If you take away the non-free float, and now you don't own the same thing that you used to, and you just have this very concentrated bet that I don't think people realize. The S&P 500 used to be a slice of the U.S. economy. It is not that anymore. It is sort of this self-reinforcing momentum, and it's like a FOMO, frenzy, AI frenzy.
Let's do a quick round of Q&As from the participants. And what is your view of your largest holding, Berkshire Hathaway, now?
Oh, God. Okay, so Berkshire Hathaway is actually not in the fund. If you check on my 13F, you will see it. We own it for a family that, in full disclosure, bought it at $19, the A shares. And is one of the fathers of value investing, the descendants of one of the fathers of value investing. What do I think of Berkshire? Berkshire is actually more than the S&P, is actually a slice of the economy. It's a conglomerate. It's a conglomerate that trades at a premium, whereas most conglomerates trade at discounts. What Berkshire will be after the passing of Warren Buffett is TBD. People often call me and ask me, what do I think about the fact that they're building so much cash? And my answer is a little dark. I think he's getting ready for something, for the end, and for what they will ultimately do. I suspect they will do a massive buyback if the share price falls. But I think the question will be, from a long-term standpoint for Berkshire, is what happens to that company? Is it allowed to maintain its sort of conglomerate status, and can that be protected? The special sauce. And I don't. That's a crystal ball question.
Another question: can you give us your predictions for 2025 in the U.S. stock market? Very briefly.
Oh, gosh. No. Look, the market's got a lot of momentum. I think that we've got a president now who is anti-regulation. He's drill, baby, drill. I think there are companies to invest in that will capitalize on sort of smoother regulation and more fossil fuel independence for the United States. But I don't think that the only place to benefit is by owning, NVIDIA.
Final question from a participant here. You invest in companies with a global presence. How will your investment decisions be affected by tariffs imposed by the incoming administration?
So I think onshoring for the United States is a very big issue and a very big trend. There will be, as a result of that, I think as a result of COVID, we've learned that we cannot have this super efficient supply chain dominated by a couple of countries that may or may not be our friends. And so I think tariffs, ultimately, if you read what the incoming Treasury Secretary says, tariffs will lead to freer trade over the long term. May there be some hiccups? Yes.
And will it affect your investment decisions?
Already onshoring is something that we are positioned to capitalize on, and I expect to continue that going forward, if that's helpful. Yeah.
All the best for the new year.
Thank you.
Many thanks, Jennifer Wallace.
Terrific.